Today, we're going to be speaking about gaps. Specifically, I'm going to be speaking about two of the most typical types of gaps that we see. So there's a lot of different types of gaps. They have all these different types of names. You've got your breakaway gaps, your common gaps, your continuation gaps, exhaustion gaps, ex-dividend gaps, news gaps, earnings gaps, many different types of gaps. Specifically today, I'm going to be speaking about two of the most typical that we see. One is going to be the common gap, also sometimes referred to as an area gap, and the other is going to be the breakaway gap. But to take a little half step back first, when it really comes down to gap analysis, sure, we have all these different names for these types of gaps, but the root of gap analysis is really about understanding supply and demand, just like everything else in technical analysis. The question that you want to be asking yourself is, what does this gap in the marketplace for this stock or for the market due to the participants who are currently involved in the market? Does it put people into the money? Does it put people out of the money? And therefore, what are they most likely going to do next? If you can understand how this gap is positioning the people who are already in the marketplace, then you can understand what they're most likely going to do next. If you know what they're probably going to do next, then you know which way the market's going to move. Let's jump into two very typical types of gaps that we see. The first type of gap that I want to speak about is called the common gap, also known as the area gap. The reason why it's called a common gap is probably because this is the most common or typical type of gap that we see on a day-to-day basis. The common gap is a gap that occurs within an area of previous price congestion. So, a common gap, also known as an area gap. A common gap, again, is a gap that occurs within an area of previous price congestion. Or in other words, it's a gap that's occurring where the stock has traded previously in the past. So for example, maybe our stock has been ranging. It's just been going sideways. I'm not even going to draw candlesticks. I'm just going to make it with simple lines. So maybe this is our daily chart for the market. It's kind of just been building out this range, and then the market closes one day, let's just say right here. And now the next day, we can say that we have a common gap up. So the market gap's higher. We'll do it in both circumstances. So the market closed here. This is the closing price. And this right here is going to be our opening price. And again, you can see that our stock here or our market has just been in a really big range. Maybe we have some resistance on this range. Maybe we've got some support on this range down here. And again, we're just having a gap occurring within this broad range. So, common gaps tend to get filled. What is a gap fill? A gap fill is basically when the price action that day trades through and fills that gap. So if today this is our price action and it comes right back down to where we closed the previous day, that would be your gap fill. So again, like I was saying earlier, whenever we are looking at any type of gap, the question that we want to be asking ourselves is, what does this do to the market participants who are already in the marketplace? What are they most likely going to do that morning? So let's think about what this common gap higher does within this range to every single possible market participant who's out there. Okay? So let's say that last night you went home long our stock. You went home long. And you go home, you have a great dinner, you get a good night's sleep, you wake up the next morning, you log into your trading software, and guess what? You're making some money. You worked really hard for that money, you just woke up and there it was. What are you going to be more inclined to do? Are you going to be more inclined to just sell some of that and book some profit, or to come in and buy a lot more? Most likely, you are going to be inclined to sell some of that stock and book some profit. It was easy money. You went to bed, you woke up, you're up some money, let me book some of that cash. Well, that's selling. That's selling pressure. What if you were flat yesterday? You had no position in it yesterday, and you were thinking, maybe I want to be long this stock, but at this price here where we just closed, it's a little bit too expensive. And now the next morning, it's at an even higher price. Are you going to be inclined to buy at an even higher price when even yesterday's price you thought was too high? Probably not. So people who are flat yesterday but were thinking about getting long are probably not coming in and buying. They're not buying. What about short sellers? Let's say that you were short the stock yesterday and now it's gapping against you today. It means you woke up this morning and you're losing some money. Well, that's not good. No one wants that. But are you losing so much money here that you're panicking out of the position? Probably not, right? It's still within the same range that it's been in. Who knows exactly where you shorted, but it was probably somewhere within this range. And not only are you not panicking out of this position that you're down a little bit money, there's a good chance that you're actually going to add even more, because you're able to add more at a better price. Maybe the resistance of this range is where your stop loss has been for your short sale. And now you can come and you can add to your position at an even better price for lesser risk. So someone who is already short is, again, not going to be buying and panicking out of the position. They are actually probably going to be either doing nothing or shorting more, which is selling. Same thing if you were flat but considering going short. You were flat, you had no position, you're thinking about going short, but you want to be short versus maybe this resistance, and the risk reward on this closing price to this resistance is a little bit too much risk, you don't do it. Now the next day the position's gapping up against you and you're like, oh, this is great, I can finally enter my short for a reasonable risk reward. Again, selling. So what we have here on our common gap, now that we've assessed every potential buyer and seller who could be in the market, is we've got a whole bunch of potential selling, longs booking profit, shorts entering positions, and we do not have very much buying coming in. Therefore, common gaps higher tend to get filled. It tends to lead to that selling pressure that fills the gap. It should be noted that it is very typical to see a gap fill act as some sort of intraday support or resistance. What about a common gap to the downside? So, here's my eraser. So, yesterday, here's our closing price. And today, we gap down. And this becomes our new opening price, a gap down. All right, let's go through our same thought exercise. Yesterday, you're long. You go home, you get that great night rest. Next morning, you come in, you're losing a little bit of money. Well, that stinks. But are you losing so much money that you're panicking out of this position? Are you losing so much money that you need to sell for a loss? Probably not, because again, it's still within that same range. And maybe this bigger support level here has been your stop loss for your long position, and now you're saying to yourself, you know what, not only am I not going to sell my position for a loss here, I actually want to buy even more at a better price. I want to buy more for less risk. I want to buy more at a cheaper price. So the longs, they're probably not panic selling out of their positions, and if anything, they're probably coming in and again, buying more. What if you were flat? You were flat and you were like, I really want to be long this stock, but this price here at today's close, it's just a little bit too much. It's just a little bit too expensive. I'm not ready to do it. If I can get a little bit of a cheaper price, I might be interested. Bam, next day, market's gapping down. There's your opportunity. You're getting that cheaper price, you're getting that better risk, whatever it is. So you're flat and you have a higher probability of coming in and buying. What if you're short? You're short yesterday. Market closes. Next day, it gaps down. You wake up. You're making money. You're in the money. What are you inclined to do? Are you inclined to short even more? Or are you inclined to just book some of that profit by covering some of your position and buying some of your stock back? Once again, you are going to be more inclined to cover some of your short and buy back that stock. So it's basically the supply and demand dynamics here are the exact same thing as when we gapped up, but kind of in reverse. And this buying tends to lead to our gap fill during the day. So this is a common gap, also referred to as an area gap. This is probably the most typical type of gap that we see on a day-to-day basis in the marketplace. It's a gap that's occurring within an area of previous price congestion, and common gaps tend to get filled. Do you want to trade with me and my team in real time? Right now, we are offering 75% off on your first month of my virtual trading floor at the Pro Desk. Pro Desk is usually $195 a month, but right now we're giving you the opportunity to get involved for just $49. As part of your Pro Desk subscription, you're going to have access to my team's daily pre-market meeting, afternoon meeting, and our daily group Q&A session. So, click the link in my description to learn more.